Really putting on our detective hats. We're going to strip away all the headline noise to investigate the real story hiding behind DKSH's Q1 2026 numbers. Now, if you've been following the consumer and healthcare distribution space, you already know DKSH is an absolute massive player. But their latest earnings report, well, it's packed with hidden details that most retail investors are just completely glossing over. Details that tell us exactly where their future earnings are headed. So, let's get right into it.
We have to start with a central mystery that has honestly been confusing the market for a while. Think about it. How can a company operating in a defensive, resilient sector, consistently growing its revenue by 6 to 8% annually, suffer from such a mysteriously low PE ratio? It's a classic paradox, right? Normally, when you see top-line growth, you fully expect the valuation to follow suit. But here, the market is applying a serious discount. To understand exactly why, we need to look way past the shiny press releases.
You see, DKSH is a total powerhouse in consumer and healthcare distribution across Malaysia. Literally, they are the invisible engine behind the products sitting on your local pharmacy shelves and your grocery store aisles. But taking their headline numbers at face value is a huge mistake, and it's one we are going to help you avoid today. We're going to uncover 5 crucial, overlooked insights that tell the real story of their financial health and their true earnings quality.
Which brings us to our first major theme, something I like to call the headline illusion. Because if you just glance at the top of the income statement, everything looks totally fine. Top-line revenue grew a really solid 6.1% to 2.35 billion ringgit. Awesome, right? But here is the catch. Net profit only eked out a tiny 2.9% gain, and net margins actually compressed by 6 basis points. This is a big red flag signaling a troubling loss of operating leverage. You have to remember, B2B distribution runs on razor-thin margins, so volume is absolutely everything. In a truly healthy distribution business, revenue growth should naturally produce proportionally higher profit growth because of fixed cost absorption. When that simply isn't happening, you really have to stop and ask yourself, okay, where is the money leaking?
Well, digging beneath the surface, our first major clue is hiding right in plain sight on the balance sheet, specifically under trade receivables.
The allowance for trade receivables skyrocketed by an astonishing 224%. It jumped from 1.2 million ringgit in Q1 2025 all the way to 3.9 million ringgit in Q1 2026, and that's just in one single year. This is a massive jump that easily gets buried in the footnotes, but has a massive impact on the underlying quality of their earnings.
The absolute crucial point here is that this isn't just some harmless accounting entry. No, this incremental provisioning directly hits the bottom line, effectively erasing over 2.7 million ringgit in potential profit before tax. To put that into perspective, total profit only improved by 1.4 million ringgit this entire quarter, meaning if we didn't have this massive spike in receivables provisioning, their profit would have grown by 9% instead of a really sluggish 2.9%. It's a massive drag on their actual earnings power. And it begs a huge question for future earnings. Is this just a one-off adjustment, or is this a deeper structural issue where clients are increasingly failing to pay their bills? Because if clients are feeling the squeeze, this headwind absolutely isn't going away anytime soon.
Okay, moving right along to clue number 2, which forces us to look at the actual cash moving in and out of the business. We need a reality check on their operating cash flow. Is a massive operating cash outflow a total disaster, or is it just business as usual?
Now, at first glance, seeing a negative operating cash flow of 52.4 million ringgit looks incredibly alarming for a business that's reporting a profit. But you really have to understand the inventory trend here. For a big distribution company like this, Q1 cash outflows are entirely normal. They are purposefully building up working capital ahead of the post-festive restocking cycle. And when you actually compare it to Q1 of 2025, which had an 81.9 million ringgit outflow, this year's number actually represents a massive 29.5 million ringgit year-over-year improvement. So while the absolute number is negative, the underlying trend is actually a genuine, undeniable positive for their cash flow quality.
Let's dive into clue number 3. For this one, we have to look closely at segment performance. We need to see exactly how different parts of DKSH's business are pulling the overall company in completely opposite directions.
It's no secret that consumer goods and healthcare completely dominate their revenue mix, but the real standout story here is healthcare. This segment just crossed a massive structural milestone, generating over 1 billion ringgit in quarterly revenue. Think about that. This growth is structurally underpinned by Malaysia's aging demographics, a rising chronic disease burden, and globally expanded healthcare spending. Over a 5-year horizon, healthcare is very likely going to become their majority earnings contributor. But while healthcare is aggressively pushing the company forward,
There's the other segment, and this is primarily Famous Amos. It makes up a tiny 1.2% of their total revenue, yet it swung to a loss this quarter. In fact, Famous Amos is a bizarre structural drag that is loss-making in 3 out of 4 quarters every single year. It basically only turns a profit during the Q4 festive season. It diverts valuable capital and management attention completely outside of DKSH's core B2B distribution competency. I mean, managing a massive, highly regulated supply chain for life-saving pharmaceuticals is one thing, trying to sell chocolate chip cookies in a shopping mall is quite another. It really makes you wonder why they continue to hold on to it.
All right, clue number 4 requires us to investigate these costs that management claims are just, temporary bumps in the road. But as we're about to see, margin sustainability is becoming a very real concern.
First up, surging unhedged foreign exchange losses completely wiped out 4 million ringgit this quarter. That's up from just 500,000 a year ago. Because DKSH handles massive volumes of imported goods, buying inventory in US dollars or euros but selling them locally in ringgit, a weaker ringgit creates painful immediate mark-to-market losses that directly drain their margins. Second, take a look at the supply chain reorganization costs. Management keeps calling these one-off costs, but guys, they've now cited them in 3 of the last 5 quarters. When a supposedly one-off cost appears this frequently, we really have to stop and question it if it's actually a permanent structural drag slowly eating into their long-term margins.
Which brings us to our 5th and final insight. For this, we are zooming out to look at the macro picture, starting with a massive, undeniable shift in exactly how management talks about the future. The tonal whiplash here is impossible to ignore.
Just a short time ago, back in their FY 2025 outlook, management was incredibly bullish. I mean, they were explicitly boasting about strong macroeconomic momentum and how wonderfully positioned they were. They painted this picture of clear skies, smooth sailing, and really robust growth ahead.
But wow, compare that to this quarter's outlook. It is a total 180-degree turn. Now, suddenly, the market outlook is highly uncertain. They're totally focused on merely navigating the prevailing environment. This highly cautious, almost defensive tone reflects very real fears over global trade tensions, potential tariffs, and ongoing FX volatility. And listen, these aren't just empty worries. They are crucial leading indicators telling us that management absolutely expects future earnings to be under serious pressure.
So let's tie it all together. Why is the PE ratio so consistently low? Well, the market is looking at a perfect storm of caution, and it really comes down to 4 key factors. First, there's the privatization overhang following the EGM rejection on April 2nd of the parent company's delisting offer, which is absolutely keeping institutional investors cautiously on the sidelines. Second, we have that mixed earnings quality we talked about. Remember, some of their profit this quarter was actually artificially inflated by 3.9 million in non-recurring derivative mark-to-market gains. Third, they abruptly suspended their FY 2025 dividends, which, let's face it, never sits well with income investors. And finally, those structural margin pressures we just discussed, from rising supply chain costs to spiking receivables. You combine these 4 factors, and it perfectly explains why the stock's valuation remains completely grounded, even with that top-line revenue growth.
So as you look beyond the headline growth, you ultimately have to make a decision based on the evidence. Is DKSH simply a value trap weighed down by messy earnings quality, permanent temporary costs, and lingering corporate uncertainty? Or, with a healthcare segment that is structurally booming past 1 billion ringgit a quarter, is this actually a sleeping healthcare giant in disguise? How you weigh these underlying clues will entirely define your outlook on the company's true value. Thanks so much for joining me on this explainer, and remember, always keep questioning the headlines.